Scott Kinne here, First Heritage Mortgage. Is your favorite mortgage lender really looking out for you and most importantly, your clients? Yes, I'm sure they get the loan closed at least most of the time or you wouldn't still be using them. I have one question for you to ask your favorite lender, and it will tell you if they are truly looking out for you and your client's best interest. The question to ask: I'm interested in refinancing to a 15-year mortgage. What is your rate? If they simply quote you a rate after asking certain parameters of your loan, then they are not looking out for you. And if they don't look out for you, then they won't be looking out for your clients you refer to them. Here is why. And if you've called me in the past with this question, you know my answer. Yes, a 15-year mortgage provides you a lower rate. But at what expense? Here are 4 things to consider. Number 1, there's no flexibility in your payment. This means make the higher payment and hope you never lose your job, get divorced, become ill and laid off from work for a while, incur other unexpected expenses, and other things. Number 2, it builds debt equity. If you plan to sell the house prior to the 16th year, the glory years, then all that money you scrimped and saved to make that payment was simply being put in your dresser drawer and not earning interest. And that drawer is locked. You can't get to your money in times of need unless the bank says so. And that is typically the time when you need it that the bank will say no. Number 3, now you have a larger debt showing on your credit report. So if you decide to buy a second home or an investment property down the road, it'll be harder to qualify for that mortgage. And most importantly, number 4, as to a lower rate, well, let's compare. Today's rate for a conforming 15-year mortgage based on a $300,000 loan with 20% equity is at around 2.75%, providing a payment of $2,036 per month, while a 30-year is at 3.375%, providing a payment of $1,326 per month. So a spread of about 5/8%, with the 15-year mortgage costing $710 more per month, or 54% higher payment. Okay, you say, but you pay off the loan in 15 years sooner, saving tons of interest. Well, there is a better way that provides flexibility. Take the 30-year mortgage, but make payments based on the 15-year loan. By making the artificial payment of $2,036 on the 30-year fixed rate loan, the loan will actually pay off in, take a guess, 15.88 years. Yes, you pay about 1 year longer due to the higher rate on the 30-year fixed rate mortgage. But now you have flexibility. You can drop down to the lower 30-year payment level if you run into financial difficulty. You have a lower debt reflected on your credit report and a slightly greater tax deduction since the interest rate is a little higher. From here, we can then talk about my philosophy of shaped lending, but that is for another video. Remember, if your lender doesn't provide you this information prior to giving you or your client a 15-year mortgage, then he just wants his commission and doesn't truly care about the customer's needs. Is that the lender you want working for you? I'm always available. Call me.